Ladies and gentlemen, boys and girls and children of all ages, I just had my microphone muted and did not realize it, but we're going to play two videos for y'all today. We're going to talk about the Federal Reserve, what they had to say about interest rates, and also Warren Buffett talking about missing the market drop of March of 2020. Prince, who cares? Warren Buffett, who wants to hear about him missing the market in 2020? Because even though this man is 92 years old, been investing for 60 something years, he still has a hard time of timing the market. And also, he's going to give some good nuggets about timing the market. This is from the annual meeting that I was at last weekend, last weekend in Omaha, Nebraska, with him and Charlie Munger. So, if you haven't done so already, ladies and gentlemen, go ahead and make sure. I'm at 47,800 subscribers on YouTube, trying to get that 50 mark. It seems to be very hard. So y'all hit the subscribe button. Y'all share this around. Y'all want to help me out, hit the like button if you like this content. And if you don't like this content, hit the like button anyway and share it with your friends. But if you haven't done so already, ladies and gentlemen, you already know what time it is. Please go ahead and make sure. Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. Ladies and gentlemen, the first video I'm going to play is from the Federal Reserve, Jerome Powell, raising interest rates by 0.5% about 2 days ago, but I was kind of busy, didn't get a chance to really stream it. So we're going to tune in live and hear this together. Why is this important? Ladies and gentlemen, this is why everybody's scared of a recession. Back in the early 80s, when inflation hit double digits, I think it was up around about 14%, the Federal Reserve raised interest rates all the way to 20%. This, in return, caused what we know as a recession, 2 months of declining GDP. So now that people are seeing this, they're seeing the Federal Reserve raise interest rates. Everybody's becoming scared of what the Federal Reserve is going to do. This is why it's very, very imperative that you listen to the Federal Reserve as what they're saying. You get it from the horse's mouth, and I'm going to give you guys and girls some commentary as well. So let me go ahead and roll that beautiful beam footage. Tripping on my words tonight.
First time in a couple of years.
Here we go. Let me know if y'all can hear
Before I
this.
go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people.
Let me know if y'all can hear this. Hopefully y'all can hear this too.
Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this,
now he's talking about the labor market. The job market has become extremely too tight, right? You're seeing people have a hard time with the finding different employees. So, and inflation's at 8.5%. How do we curb inflation? How do we get inflation down? You're seeing interest rates on homes go up to 5.6%, 5.5 on a 30-year fix. So let's take a look.
This backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months.
That's good. Labor market is good because when the labor market is doing bad with high inflation, that's when you get into stagflation that they saw in the early 80s. Let's keep going.
So the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation.
So right now, he just said it. Crude oil prices have been going up because of the Russia-Ukraine situation. That's the only thing that's really making money. Shout out to that BPT. If you got some, that's been money for people out there who invest.
And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy.
So they're reducing their balance sheets, meaning that instead of pumping money into stocks, they're stopping the purchase of buying stocks when they're reducing their balance sheets, right? So right now you see in the Federal Reserve, they're saying, hey, that we're not going to pump as much money that was pumping into the market, and we're raising interest rates. This is why we're seeing the S&P 500 off to its worst start ever.
We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year,
Really?
and further surprises could be in store.
Really? They're saying
We therefore
inflation has surprised us. You don't remember those trillions of dollars that you pumped into the market back in 2020? Come on, man, that's laughable. You pumped trillions of dollars into the market 2 years ago. You're like, oh, inflation is at 8.5%. Definitely surprising us. Come on.
will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
There you have it. Federal Reserve Chair Jerome Powell. I think he's very genuine when he speaks for some reason. I listen to him, and I think he's very genuine with what he says. I think that he has the best intentions as an investor to say what you're doing. So, ladies and gentlemen, all I got to tell people is if you out there, you're in the investing world, you know what I'm going to do with my military 401k? I'm going to go in and I'm going to raise it up 1% or 2%. These are the times you go in and start investing, right? When everything looks gloomy, everybody is scared, everybody's worried about what's going on. This is the time to start investing or to double down on your investments. Remember that time I told everybody, hold, make sure you have cash in a recessionary period. You want to have cash. This is the time. Prince, where are you going to look to invest? Me, two ways: for the short term, oil; for the long term, look at all these tech stocks just getting obliterated. All of them. How do you know that stocks are doing very bad when you got all of them down? S&P 500, NASDAQ, everybody is down. This is the time you start to get in. And now I'm going to play this next video that I want y'all to see. This is coming from Warren Buffett. Warren Buffett here. He is, last weekend I was in Omaha. And when I was in Omaha, this is what he said when he talked about March 2020. Remember back in March 2020, some of you guys and girls was live and y'all was talking about, oh, the stock market is crashing. What am I going to do? What am I going to do? What am I going to do? Then in 2021, you said, man, that was a great time to jump in. This is when I need to jump into an investment. But here it is for the world's greatest investor himself, Warren Buffett, who's 91, 92 years old, been investing twice the time of my lifetime on timing the market, being able to time the market. Let me roll that beautiful, beautiful beam footage.
I will take it. The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on, maybe about how learning takes place, but we have never, I don't think we've ever made a decision that where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. And the interesting thing is, sometimes I get some credit someplace for the fact that, how wonderful it was that we were optimistic in 2008 and when everybody was down on stocks and all that sort of thing.
So you just said in 2008 how optimistic they were. Let's see what they got to say about 2020.
We spent a big percentage of our net worth at a very dumb time. and I shouldn't say we, it's I. We spent about $15 or $16 billion, which was a lot bigger to us then than it is now. We spent it in the last few weeks. There was a period of 3 or 4 weeks between Wrigley and Goldman Sachs and General, at a terrible time, as it turned out. I mean, I didn't know whether it was going to be a good time or a bad time, but it was a really dumb time. And I wrote an article for the New York Times and Buy American and all these things. Well, if I'd had any sense of timing and waited 6 months until, I think the low was in March, and in fact, I think I was on CNBC maybe that day or something, but I totally missed that opportunity. I totally missed, in March of 2020. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money, and we had no idea when we bought anything. Well, we always hoped it would go down for a while so we could buy more, and we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, and in fact taking our interest up. I mean, that's stuff you could learn it in fourth grade, but it's not what's taught in school. And I mean, so never give us any credit. Well, actually, give us all the credit. I mean, go out and tell everybody how smart we are, but we aren't. We haven't ever timed anything. We've never figured out insights into the economy. I mean, when I was 11 years old, March 12th, I guess, 1942, March 11th, I bought stock when the Dow was 90, well, it was 101 in the morning. It was 99 at the end of the day, I think. And, now it's 34,000, or maybe it's 1,000 less than it was.
Thinking about it, he's talking about how they missed out on March 2020, that big dip we had when the pandemic got announced, right? So that's what he's talking about right there. Of like, hey, in 2008, we brought up Goldman Sachs, General Electric, all these different companies back in 2008 when it wasn't a good time. You're talking about the financial industry collapsed at that time. And he's talking about, hey, we turned around and bought all these things then. So now he's talking about, man, in March 2020, we missed out on a lot. So look at this. These old guys, you're talking about 100 and how old are these guys together? Probably almost 200 years old. Charlie Munger, 98 years old, Warren Buffett being 91, 92 years old. And sitting there listening to these guys talking about missing the market, trying to time something. That's when people come in and say, hey, I want to time this will be the perfect time. I don't know about that. Let's play.
On Thursday. But I just, it's one decision.
All right. So there it is, right? That was Warren Buffett and Charlie Munger. I'm going to be breaking down some of their pieces where they talk about trying to time the market and how they missed out on 2020. When you look at it on hindsight, it's very easy to look at the chart and say, man, 2008 was a great time to buy houses and buy stocks or whatever. The crazy part about the downturn, you don't know that you're in a downturn until you are out of it. March of 2020, even I was live watching the market, telling you guys, keeping a pulse on it. It still was hard to go in there and to know where the bottom was. Today, the Dow Jones is off to its worst. The S&P 500 off to its worst start ever. 1,000-point drop yesterday. Another 100, 200-point drop. Week after week after week. Interest rates, you saw the Federal Reserve just talk about interest rates, raising them up 0.5% as we try to cool off inflation. And I told you guys and girls, by this summer, we're going to be at double-digit inflations, right? So when this CPI report comes out, the market's probably going to go down even more because we're going to find out that the CPI report is going to be at 9%. People are going to be very shocked with that. So let me see what y'all saying in these comments, but that's what I want to kind of preach on today and talk to y'all. Al, what's going on, my guy? Always tuning in. Angelina says, right now, I don't think people can afford an interest rate hike again. Yeah, people can't afford it, but this is a way to cool off the market. The reason why they are pushing up that hike is to cool off the market. They don't want you to be able to afford it. It's to tighten the money supply that's out there. When you raise interest rates, money becomes more expensive to buy, and it tightens money. So yes, people, so in the 80s when they raised interest rates so high that it caused a recession. That's why people are having fears of a recession right now, because we're trying to cool off inflation. And sometimes chasing down inflation can actually put us into a recessionary period. That's why you have that big fear, right? So they say, hey, man, this is raising interest rates is not good for the average everyday person. I'd rather have higher interest rates than to have 10 digit, than to have 10% inflation. So what would you rather have? Interest rates or inflation out of control? I take a little bit of interest rates. LLJ, what's going on, my guy? LLJ in the building. What's going on? He says, what? I can't believe I caught a live video. Yeah, I'm very sporadic, man. I jump on here. I get on here and see what I got to say. I'm in Denver, Colorado. I'm 2 hours behind the East Coast. So sometimes my video is a little bit later or whatever in the day. And I do have a lot that's going on in my life that I have to read. I'm still a dad, still active duty military. I'm getting pulled 3-4 different ways. I'm actually out here live in the community, going to events, doing things with my family, being a good friend, a dad, an uncle. And it does get a little stressful to come on and do live sometimes, right? To be able to put it in. But as my military career starts to fade as I retire, 20 years of service, shout out to me for 20 years of service, that is going to open up more time to be able to do more of what I love to do. Kevin Torres. What's going on, Kevin Torres? Like you put a love button there. Okay. Kevin Torres says, EV Mule. I don't know what you're saying there. He says, LLJ says, always waiting on times like this. Blood in the streets. Dip, baby, dip. You are very correct. See, times like this is the times people look out and you don't have cash. If you already own assets, you can't do nothing but look at them. But if you do have cash, this is, if you're not this smart, you're not the savviest investor, go in and boost up your TSP contribution. If you're in the military, go into your job. If they offer you a 401k, boost up your contributions a little bit. Like, hey, you know what? I can do 1% more of my paycheck to go into a time like this, because this is the time you want to go in and buy. Because next year you're going to be like, I should have. Man, you remember last year when oil prices was going crazy and gold and oil was going up? I'm very tricky about oil. I'm very short term on oil. I'm not a long-term oil person, but in the kind of economical times like this, you always see the price of gold and oil raise. And I also said OLN ammunition has been doing surprisingly good this year. Kevin Torres puts 100 up. What's going on, Kevin Torres out there? Appreciate you for tuning in, Kevin Torres. I'm not familiar with you all the way. LLJ, I know you are Gary's brother down there in Augusta, Georgia area. So yeah, ladies and gentlemen, that's what I wanted to touch on today, talking about what the Federal Reserve just said about interest rates, raising them by 0.5%. And you're seeing the 30-year mortgage go up. As mortgage rates go up, this in return is slowing down the housing market. Right now, they're telling me on Redfin and Zillow and whatever, they're saying my house is worth over $600,000. But guess what? The interest rate's at 5%. How many people can afford a $600,000 house at 5%? That's going to cool down the market of buyers. That's going to slow down the market of buyers. People are saying, hey, why would you want to do that? That is a way to cool down. And you got to think about it. Real estate, your housing value is supposed to go up 3% a year. 3% a year, not 20, 30, 40%. Because what happens to when you have a bubble? A bubble will eventually burst. When interest rates are very low, it creates bubbles in the asset world. So when you raise interest rates, this is when you start to see things get undervalued. When interest rates are down, assets become overvalued. When interest rates start to go up, assets have a tendency to become undervalued. This is a time for investors to start to come in and do certain things. So the Federal Reserve, Jerome Powell, he doesn't seem like somebody who's crazy that's going to keep raising interest rates. He's raising interest rates. He's reading the CPI report. He's reading the unemployment report. He's reading the supply chain report. He's reading the consumer discretionary reports. And that's how he's making his assessments and adjustments. So right now, the only thing you're seeing on sale right now is technology. I'm very weary of consumer discretion because I think as interest rates go up, it would affect employment. I think it's going to cool off employment and it's going to tighten up that job market, because right now the job market is hot. Very easy to get a job. A lot of people are not working. A lot of people quitting their jobs. So yeah. But yeah, ladies and gentlemen, that's what I want to let you guys and girls know. Looking at Warren Buffett talking about trying to time the market, missing the market in 2020. And those are things that, well, here we go. Max B, what's going on, Max B, my guy? Max B said, with the bond yield getting up, that means people are selling bonds. No. So what's happening is, as interest rates start to climb, right, you're seeing bond yields. Not that people are selling them, it's just that the value of bond yields are starting to decline, right? Because let's think about it. If your bank account is offering you 5% interest, but a bond yield is offering you 3% interest, that means that in a higher interest rate society, bond yields start to go down. In a lower interest rate society, bond yields start to go up. Bond yields don't look as attractive in a higher interest rate environment, right? So that's what, now that people are selling, they're not as attractive to investors. A lot of investors are getting out of them because they can get better returns elsewhere. Hopefully that makes sense. So bond yields, when the people looking at the percentage on different bonds and they're looking at the percentages that's in the open market, in a low interest rate society, bonds become very attractive if they have nice interest. But in a higher interest rate society, bonds don't look as interesting, right? They're not as attractive to investors, meaning investors don't want to go to them, and it means investors who do have them start to get out of them, right? In the reverse, causes them to come into a bullish market. So not a bullish, but bearish. I'm sorry, go into a bearish market where they're not as attractive, because it's all about who's offering what interest rates are going to be doing. So yes, 0.5% on the interest rate. So we got to pay attention to that CPI report. The next inflationary report, I think, is probably due in like a couple weeks. So let's keep an eye out for that, because that's going to dictate people. The market is trying to say, can the Federal Reserve control this whole inflation that's going on? But used car prices have gone down. Energy prices are high and up. And you're seeing oil. Oil is making money right now. Technology is on sale right now. They're the ones that are getting beat up the worst. LLJ, what's going on there? He said, yeah, I had to sell the BLV for right now. Yes, BLV. Let's take a look at BLV. That's that long-term bond ETF, right? BLV. BLV says $79. Yeah, it's definitely had a nice little dip. So here we go. Let's share my screen. So here you go. You got BLV. This is a long-term bond ETF. I like it, or did like it. Depends on what's going on in the market at the time. It pays a dividend. I think, what's the dividend yield right now? Why it's not showing up on my Google, but it's in here somewhere. I think it's around 3-4% that it pays on dividend. And it usually sits flat, meaning that it just sits flat over time. Like, let's go out on the max, right? You can see it doesn't jump a whole lot. From you talking about in the last over a decade, this thing has bounced between $45 and $100. Not crazy jump, but it sits sideways and people collect dividends off of them, right? Which is a good thing, but all depends on what type of portfolio you want. But bonds right now not becoming attractive in a higher interest rate society. So look at it. You're talking about in the last 9 years, the stock only moved up about 6%. Well, not the stock, but the value of it. But it pays a nice little dividend. I don't know why it's not showing me its dividend yield currently. Its dividend yield is probably pretty high right now. I probably have to look into it a little bit more. Let's take a look at it. It should have it in here. It's a Vanguard not bond, long-term bond ETF. Let's see what it has. The NAV, I don't want to care about the NAV. Okay, about 4%. The 30 days about 4%. Expense ratio is 6.4. Yeah, about 4%. So people you can put money here and draw a nice little 4%, but it has not been looking too crazy. Kevin Torres said, what about crypto? You know what? That's a good question. Crypto right now is quiet. I think it'll come back for another bull run. I know that, I'm going to play the clip on what Buffett said about it. This past weekend, he was like, I wouldn't buy all the Bitcoin in the world for $25. Right. But then again, Buffett is 91 years old. Why would he take those type of risks? why would he take those type of chances and get into something that he truly don't understand? That goes against everything he knows and believes. So looking back on, I think if Buffett was like 30 years old, I think he'll probably have some type of crypto. So I think it's worth having a little bit of Ethereum. That's the one I look at the most and say, okay, I kind of like this one as a utility. And I think it'll make another bull run, but I think either it's a $2 trillion market now. I don't think cryptocurrencies are going to disappear. Is it going to become the next big thing? I really don't know. It's going to be a hit or miss. But it's to be said, once we create our own cryptocurrency, it's going to be very interesting to see how the other cryptocurrencies play out. So I think it's definitely something there. I definitely have exposure to them. I got a couple $1,000s in crypto, nothing crazy. If it does take off and does something, great for me. If it doesn't, then hey, it's going to be a hit or miss. So so crypto right now is very quiet. Nobody's talking about them. But I do think they're going to wake up and have a nice little run. Nobody's doing good right now. I think they have a nice little run once stocks start to make their little run back. That's what I can say about crypto. All right. Well, ladies and gentlemen, that's going to be my time for tonight. Thank y'all for tuning in. Make sure y'all hit that like button, hit that subscribe button, hit that notification button, and share this with your friends and everybody else trying to get to these 50,000 subscribers. Finally, get over this 50,000. Well, first I need to get to 48. I'm right at 48,000. Help me get to that 48,000. The next goal is going to be to get to that 50,000 and keep pushing it up and keep moving it on. It's not about the size of the audience. It's about the quality of the audience. That's what I love about the quality of the audience, that we can get in here and we can talk about investing. We don't have to talk about nothing crazy, demeaning anybody, drama, anything like that. We can talk about investing, talk about our portfolios, talk about what's going on in the market today. And I love to have you guys and girls as an audience. And I love to see y'all in person as I go around the country. So yesterday I was at, Mission Viejo. I think it was Mission Viejo Elementary School. Out there, got a chance to speak to, do two breakout sessions at the financial literacy night, the first ever financial literacy night. So yeah, definitely enjoyed that. Today I'm kind of relaxing, getting the show done. And the next tomorrow I'll be out with my wife. We're going to go to some concert that she's taking me to. So happy Mother's Day to her. Happy Mother's Day to all the mothers out there. Happy Mother's Day to your mom, your grandmom. Happy Mother's Day to my mother who passed away, 10 years ago. And my grandparents too. My grandma, all my grandparents are gone. So yeah, appreciate your mothers. I still have my father here, and I definitely appreciate him. So happy Mother's Day to all the mothers around the world and the people that are standing in and being a mother. So happy Mother's Day to your aunties too. You may not have birthed a child, but you're taking care of a child. But anyway, glad you guys and girls got something out of it. And to the next video podcast, cartoon, book, or whatever else crazy y'all see me do around the globe, LLJ says facts. That's definitely a big facts. Appreciate it. Peace. Be safe. I'm out, ladies and gentlemen, and thank you.